The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Merry Christmas, everyone. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. Merry Christmas to you, Guy Allard, my co-host.
Have you been naughty or nice?
It depends on who you ask.
That's what I was figuring.
No, this is obviously Christmas Eve. I remember when I was a kid, my parents, before we went to Mass, always let us open one present. My children, no, they can't do it.
No, none?
One year we let them, and we thought it was a mistake because they beg us every year now. So, because we don't do the midnight Mass thing anymore, we do it earlier. But that's what I remember as a kid. Getting up there, then going to sleep, and then waking up 3 hours later.
The midnight service is pretty fun, though. Usually there's some great entertainment, and the kids get up there, and good music. And
it's too late now that I'm a pawpaw. It's a little too late for me nowadays. Well, like I said, I want to wish everyone a Merry Christmas. I hope everybody has a great New Year. There's a lot of things to look forward to in the business and the finance realm.
A lot of hope.
So hopefully I understand the left says trickle-down economics doesn't work. You know, cutting taxes for corporations and the wealthy doesn't work, but worked pretty good for Reagan. And we'll see. You know, but it's still, that's what somebody told me one time. They said, you don't understand. Raising taxes is healthy for a company. I'm like, what are you talking about? Nobody could tell me if I'm a corporation and I have this much coming in and you raise my taxes, or an individual, how that helps me personally. Now, I get it. You have more government programs, stuff like that, but I don't get how it could help somebody raising their taxes.
Well, you know, the biggest argument what the left is complaining about is where's all the money going to come from that we're losing right from the tax cuts. They don't buy into the stimulated economy and the growth and the more jobs well, shoot, just since Trump was elected, how many days ago?
I don't know, a month ago.
Let's call it a month ago. It's gone up 8%. Do you know how much money that's created? It's like $1.24 trillion created.
Right. It could be. I'm always a cautious person.
What's 15% on that? Long-term capital gains. There's some revenue there created, right?
I'm just always cautious. They have the election bounce and then the inauguration drop. So if it gets through that, though, I'll feel better.
I tell you what, though, I mean, if you listen to the different people and you do some reading as far as what's going on, we've been through a lot already since Trump's been elected. A couple terrorist attacks, all sorts of things. The electoral challenge, if you will, and the market's just been a steamroller. In fact, it went up 1,000 and or 2,000 points quicker than it ever has before.
I know my son believes, my oldest son, my 30-year-old. He believes it's the end of the world as we know it. I told him it's not the end of the world. It'll be fine.
I talked to a client Thursday that voted Democratic for 40 years. His wife's a teacher, good guy, we're good friends, voted for Trump. And he said some of his family members absolutely believe in their heart that it is the end of the world. They don't know what to do. They're beside themselves.
All I look at is, like I said, there's a potential lowering personal income tax, which could have more money in your pocket to spend more, save more, whatever. Corporate tax being lowered, because corporately we do have one of the highest tax brackets in the world.
And what does that cause?
Right,
money to go offshore.
Keep it out there.
And when the tax environment is right, when the regulatory environment gets better, which it's proposed, we got to wait to see what happens. I'm with you. But what happens? Money now, the world believes that the United States is probably the best place to invest for the next 5 years as of now, as things change. So what does that do? Money starts coming to us. Our economy gets fueled. There's hope. Everything gets rocking.
Well, let's hope so. Like I said, I'm always, what do they call it? Tempered optimism or what?
Cautiously optimistic.
There you go. I don't, like I said, everything we do, financial planning wise, everything is always based on what if something bad happens? Am I still okay? And that's where you should always plan for your financial future. Please, I know there's some crazies on the left, just like there's some crazies on the right. Please don't call me, yell at me for talking about fiscally what could happen to your investments from the new administration, because I've got those calls and those emails, and sometimes they're a little scary.
Oh,
I'm
yeah.
like, whoa, man, calm down.
Over the years, think about it. And there's 3 or 4. You'll have to help me out. But you've been balled out for by the Possum Society.
Oh, that's right. National Possum Society in Fort Worth. Yes.
Using a possum, the Jed Clampett commercial. There was a scathing one that you got. The guy wanted to punch you for something. Remember?
Oh, no. Well, one of them we were talking about that study of why there was a study sponsored by the government.
Right.
Why gay women were heavier than gay men.
That's right. And
I
one
said
of them.
it's kind of interesting, but I don't think the government should pay for it. Oh, I got some bad ones. How dare you? But I'm like, I'm just saying I don't think government should pay for studies like that.
Who was the guy? His name was Tim. Said that I was the biggest blowhard he'd ever heard on the radio. I forgot what I even
Well, that
said.
part's true.
Well, many a truth is said in jest.
That's right. All right, let's get to the show. RMD reminders. RMD is your required minimum distribution. Okay, once you turn 70 and a half, you have until April 1st of the following year to take a portion out of all of your retirement accounts. The exception to that is your retirement accounts that you're still working. Let's say you have a 401k, 403b, something like that, and you're still working there. You don't have to take out RMDs until immediately after you retire, and you're over 70 and a half, of course. But if you do not take it out, what's the penalty, guy?
50%. That's
right.
Terrible.
So if you're supposed to take out $20,000, they're going to penalize you another $10,000 if you fail to take out your required minimum distribution.
And a quick note there, if you're working for a company and you're going to continue to work and you're over 70 and someone wants to talk you into doing an in-service withdrawal at that point and go into one of their investments, obviously that exposes you. You now have an RMD, so you have to really think twice about whether you want to do that at that point.
Right. I've had some people do it anyway because they wanted another time of investment.
Right.
But they kept some in there that they can move to an IRA.
Defer still.
Because you can take out of any IRA the combination of your entire RMD. In other words, you
Absolutely.
have 5 RMD IRAs. You can take it all out of the one, but it's going to equal probably around, if you and your wife are within 10 years of each other, it's around 3.75% the first year, something like that. And it goes up every year.
In other words, if you had a total of $500,000 worth of money in IRAs, 6 or 7 of them, you just have to satisfy the amount on $500,000 from any one or a combination thereof. It doesn't have to be equal from every single account.
Right. And there's a factor. The first year it's 27.4. So if you divide your investment by 27.4, which is basically taking about 3.75% out of it.
Right.
Something like that. Remember, if you're doing inverse math, if you're doing about 25, it's 4%, because 4 times 25 is 100. Huh? Right.
Very good.
So what you do is now there's people that forget when you inherit an IRA, you also have those kind of RMDs, and those are a different kind of table. Okay, but you got to do those. It's IRS publication 590-B.
Unless it's a spouse.
That's right. Spouses, it goes into the spouse's name, and if the spouse is under 70 and a half, they don't have to take the RMDs yet. There's also some rules if the decedent was already taking RMDs or not, but it's very careful. Be very careful. If you have an advisor, you have a brokerage account out there, or you manage your own money, be very, very mindful of required minimum distributions. We don't want any of our listeners out there paying a 50% penalty. Because it's a steep one. And, the government needs their tax money. Somebody always asks me, why do they do that? Because remember, those IRAs, 401ks, 403bs have never been taxed. If they allowed you to keep them forever, they'd never get their tax money. So what they're going to do is they're going to start making you take it at 70 and a half and then increase the amount you have to take every single year until your death.
It's the same reason in 95-ish, correct me on the year, when with Roths, they gave amnesty. If you wanted to take all of your money one time and put it into a Roth, you could. Well, the reason was they get taxed on all of it.
That's right. The Roth conversion deal was a great boon for the government.
It wasn't helping us.
That's right. Everybody thinks, oh, they did us a great favor.
Oh, yeah.
All they did was figure out how to get all the tax money up front.
That's right.
It would have taken them 30 or 40 years to get. And so converting one to the other, it only makes sense in certain instances. Okay, so be very careful. If you have any questions about should you convert an account to a Roth IRA, call us, because I've seen too many. I've heard radio shows talk about it. I've seen white papers on it, and they are missing the boat. Sometimes you should not. I said most of the time you should not convert a regular IRA to a Roth unless your retirement taxation, the taxation that you're going to get in retirement, is somehow higher than when you were working, which is very, very
Or as high.
abnormal.
Right.
Normally, you got a job, you got a check coming in. Obviously, you're paying more taxes than when you're just withdrawing money out of retirement accounts when you're retired. And don't hesitate to call us if you have any questions. It's 972-715-2424. Remember, if you'd like to take advantage of our no-cost, no-obligation retirement plan, Social Security Optimizer, or just have a financial question, again, our number, 972-715-2424, or you go to our website, ilovemyretirement.com. Stay with us, folks. We have a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, folks, if you'd like to take advantage of our no-cost, no-obligation retirement plan, retirement stress test, Social Security Optimizer, or have any financial questions, we're here to help. 972-715-2424. Again, 972-715-2424. You're always welcome to go to our website at ilovemyretirement.com. All right. Right before the break, we remembered we wish you a Merry Christmas, but also we want to make sure if you have not taken your RMD, you only have a few days left. If you do not take it, it's a 50% penalty. So remember, if you inherited an IRA, you have to take RMDs as well. That's the one people forget. On your own RMD, pretty much everybody 70 is unaware of it. It's when you inherit one or something like that.
And the rules are changed, which
Right.
I think we were just about ready to get into.
Right. So let's talk a little bit about how retirees can save on taxes. A couple of them, a lot of people aren't aware, but when you're 64 years old, right, you have a standard deduction of say $6,300, which is going to $6,350 next year in 2017. And then, but a 65-year-old gets $7,850, goes up to $7,900. Okay, so there's an extra $1,500 in standard deduction you can write off your tax, and that saves you about $400 in the 25% bracket. Couples also go to $15,200 standard deduction when you're both over 65. Okay, that's a way to say you're going to save a little taxes in retirement. And when we do our retirement plan stress test, it puts all current tax laws in there. And so it's going to account for all the different taxes if you're taking money out of retirement accounts, pensions coming in, Social Security, they add cost of living adjustments. So our system is pretty comprehensive with our retirement plan. And it puts all this in there. Remember, there's never a cost, never an obligation. ilovemyretirement.com.
You know, I've done many, many, many retirement plans, and I'm sure you have obviously too. I can't recall ever doing one with an inherited IRA. I've usually done those by hand. Have you put one of those into that software?
Yes.
And
Yes.
it does
Yep, there's a drop down inherited, and it will account for the taxation.
We didn't go through it very much in depth, but the withdrawal requirements on an inherited is more aggressive
Oh yeah,
than
lot
it
more
is
aggressive.
for a single or on your own
Right.
RMD.
Right. The you also get the medical deduction. I know if you're itemized and your medical expenses are over 7.5%, you can take it if you're over 65. But if you're under 65, it's 10%. That is only through next year, though. This year, 2017, it's going to be 10%. Your medical expenses have to exceed 10% of your earned income to count. All right. Now, there's one thing that happens a lot of times is, let's say you're retired for a little while, you're bored out of your gourd, and you want to go back to work. Well, as long as you're not covered by a spouse's employer plan, you can write off the Medicare Part A, B, or B and D and any kind of Medicare, Medigap policy, any kind of Medicare, you can write it off directly off your taxes. You don't have to take that 7.5 or 10% threshold, okay? Because you're self-employed at that time, and you can write off self-employed insurance expense, which that's what Medicare is. And so that's a good one. Also, you can also do spouse, even if one of your spouses isn't working, as long as the earned income from one of the spouses is still enough, you can still do a spousal IRA contribution. We're just talking about ways you can save taxes once you retire. You can time your tax payments. That's a little more difficult. You can use RMDs, because what happens is the IRS says once it's earned, you owe a tax, right? They don't do that with RMDs. And so you can use your RMDs to pay a tax, because that income wouldn't come in to the very end of the year, and you could have the taxes taken right out of it. So you wouldn't have to pay those estimated taxes or penalties.
Yeah, these are things just
like
to squeeze the last little drop of interest out and such.
Just trying to get, that's just a couple of ideas. Remember, you're going to get a larger standard deduction. You can use your RMD. If you do it at the end of the year, you can pay taxes with that. And it allows you in some cases not to have to do the estimated tax payments. And you got the medical deductions that are going up to 10% last year. And remember, if you go back to work and you're not covered by a spouse's insurance plan, you can deduct your Medicare Part B, D, and supplements or whatever. Okay? So that's good for that. We're going to go over your questions most of the show today. I just wanted a few topics I wanted to go over. First, the next one is talk a little bit about estate planning. We don't discuss that as much on the show because it doesn't have as many, the audience isn't broad as much when you're talking about estate issues. I know some other shows talk a lot about estate issues, but really for a lot of people it doesn't apply. But I'm going to show you the use, because if you heard my show over the last 20 years or so, you know I'm not a huge fan of life insurance, but it is necessary and actually helpful in many cases.
It's
No,
like,
go ahead.
yeah, not to interrupt you. It's like a trust. If you need one, if you've got a lot of real estate, if you're going to generation skip, I mean, there's some really good purposes, needs for trust. But if you talk to an attorney, usually they want you to have a trust for everybody.
Oh, yeah, everybody has. You got 5,000 to your name, that's
right.
a trust.
So we just try to be judicious with what's
Right.
needed.
And permanent insurance versus is needed over term insurance. And that's a hard one because I like term insurance.
Yep, it's cheaper.
But, yeah, in many cases, though, you really need permanent insurance. So I'm going to go over one example with an estate. And we don't, like I said, we don't do this very often because the estate tax is only over $10.5 million between a couple. If you're a single person leaving to your heirs, it's $5.25 million.
And it may go away now.
It may go away. That's definitely possible. So we're going to talk about if you did one of these or would it benefit you. We'll also talk about what if they do go away. How did that affect you?
Good deal.
Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome to the show. Remember, we're going to talk a little bit about why a permanent insurance policy might be a good thing for you. You know, listen to my show over these many, many years, I'm not a huge fan of insurance. You know, you got to have, if you're young and you've got kids to take care of, you got to have insurance, period.
And again, like we talked about last segment with the states, there's some good purposes, good places where they work real well. What we're against is someone that's all they do.
That's right.
And no matter what you need, that's what they're going to put you.
All your money goes into an insurance policy. That's ridiculous.
Bank on yourself. This is it.
Sometimes, though, it's pretty, like we have a buy-sell agreement. Let's say you're a partner with someone. They marry, somebody, some mail-order bride or something. And now they're going to run your company if they die. Well, you do a buy-sell agreement that pays his wife, so they're compensated for their half of the business, but you become the owner at that time. You got to be careful and really be really good friends with your partner so you don't become
That's right.
You got a bounty on your head now.
And some of these things that you've heard advertised on the radio, if you're the right age, if you can put 30, 40, 50,000 a year away consistently for 10 or 15 years, you can get a great tax-free, because you're borrowing against a policy, a great tax-free income for almost ever. But the circumstances and the situation have to line up for it to work for you.
Right. So we're going to give one example here of why an ILET trust was the irrevocable life insurance trust, what it would work on. A lot of people don't realize that, some people think wealthy people have no problems, but sometimes there's issues. I'll give you an example. Let's say you had this wealthier couple had $5 million in liquid, like stocks, bonds, CDs,
Right.
cash, stuff like that, but a $30 million business. And sometimes because you have a $30 million business doesn't mean it's producing $30 million a year, right?
It's the sales usually.
That's right. That's what they're saying. If you add it all together, there might have been a business there for 50 years, whatever. So you got a total portfolio of $35 million. Well, you got the $10.5 million exemption, which maybe the Republicans will repeal.
Maybe.
Let's hope. But $24 million taxable estate. And so what happens is you owe that, I think it's within 18 months, you have to pay $9.8 million in taxes on this business so you're passing a business down to your son or whatever, or daughter. And remember, you only had $5 million cash, and that's all marketable securities, everything. The business was worth the brunt of it. Well, what do you have to do now? Sell the business? What about get a loan on the bit, sell a fire sale, sell a portion of it? That's an issue. And so having a irrevocable life insurance trust that owns a life insurance policy where they're the owner and the beneficiary of, which would pay this tax, so your son that you want to give this business doesn't have to sell it immediately. It happens with farms, ranches. Sometimes with family farms and ranches, though, I have heard that the government will give you a little extensions and work with you a little bit more. I haven't heard that too much on businesses. I don't know that government workers really care for a rich guy that could lose something.
Well, I was going to say people in general, probably even our listeners, aren't that sensitive to somebody that has a rich problem. But you think about it, they or their family has built this business up their whole life, and now their kids can't keep it because they're not sitting on a lump sum of cash.
That's right.
To bring it into somewhere close. Think about the Cowboys. What's that, a $3 billion deal, you think?
Oh, yeah.
Was that a fair number?
Yeah.
For the team and the stadiums and all that stuff?
Oh, yeah.
If Jerry and Mrs. passed away.
Who's going to come up with $1.5 billion in taxes?
Or you got to liquidate everything.
Right.
You can't keep it.
That's why a lot of times you use a trust or something like that. So then I looked at, all right, this particular was a 65-year-old couple in good health. You did a last to die policy. Because remember, It passes husband to wife without the estate tax. But you do a last to die policy. What if I bought this thing? It's $100,000 a year in premiums to give them $10 million in money to pay the estate tax, right?
Death benefit.
What if they got rid of this estate tax 3 years into, and I pass away? Did I just waste this $100,000 a year into this policy? Well, that's when we ran the numbers. Let's say if you live 20 years, both you and your spouse live 20 years, your return on that money would have been 14.88% a year. If you live 35 years, which is both living to 100, which that's very fortunate.
Oh, yeah, no kidding.
You still get 5.5% a year. So my point with all that kind of stuff is if you have an estate issue, go ahead and take care of it, because even if they remove the estate tax, you still get a pretty good return on those assets. If you do when you're talking about policies, permanent policies, they're always more expensive because they have a cash value and other benefits than a term. But second die is the cheapest type of those, because even though you have a 50-50 chance one of you will pass away, the chances are way high that one of you will live longer. So when you do a last to die policy, they're pretty inexpensive in comparison. And so that is one of the reasons a buy-sell agreement with your business owner, you have partners or whatever, is a great place, and you need permanent insurance instead of term for those type of things. If you're doing an estate issue, like an ILET trust like we just talked about, that would be a good thing to have a permanent policy in. If you have any kind of situation like this, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. After the break, we're going to talk and answer your questions. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. This week, I had a client come into my office. He's a new client. He's been listening to our radio show for a long time.
It's about time you get a client in your office.
He gave me one of the best compliments, without knowing it, that I think you can ever get. Remember, I told you what we do here, everything is logical. You know, being a former engineer type, I like math. I don't like, I want to spare me your sales pitches and your BS. You give me the math, and if it works, I'll think about it. That's the way I operate, and that's the way I hope my clients operate. But he said, I felt no pressure with you at all. It wasn't like a sales thing at all. It was more of a, here's the information, and you're patient with me and all that. And that, to me, is the best kind of thing you could say about an advisor. They didn't pressure you in any way, and they just give you information so you can make an informed decision for yourself.
You didn't put them on the rack? I didn't hear any screaming coming out of your office. Right.
But that's the way. Remember, if you would like to have any financial questions, like to take advantage of our no-cost, no-obligation retirement plan, retirement stress test, Social Security Optimizer, or have any financial questions, our number is 972-715-2424. Again, 972-715-2424. You can always go to our website at ilovemyretirement.com. All right, it is time for our questions. Remember, these are questions that come in from individuals, prospective customers, clients, just listeners to our radio show. Anytime I think they're going to appeal to a mass audience, we're going to share them with you. We do not use names for credibility or anything else. I just don't want to embarrass someone. So if you have one of those questions, don't hesitate to call us because we will use them on the air if you'd like us to. All right, Guy, what's my first question?
Your first question is, I have a double tax basis in one of my investments, and I'll come back to that one. We are a couple in our 50s. We keep maxing out our 401ks. This is a majority of our savings, but we're really unsure of when and how we could retire. Can you give us a few rules of thumb regarding retirement?
Yeah, this is actually more common than you think, right?
Oh, yeah.
A lot of people think they're doing okay. They might be maxing out 401ks, or they might only be putting in up to the match.
And
I hear that a lot.
And right with that, people, when they plan their retirement, think they're going to retire early, and usually they get to that point and they say, I'm going to keep working.
Right. Or I don't know if I can, right?
Exactly.
Some of the best rule of thumbs when it comes to are you on track or where should you be? The 4% rule is a good one. Remember, you shouldn't take out more than 4% of your assets a year, and you can increase that by inflation.
And good news is, hopefully, perhaps, maybe, is that qualified enough? That rule may go up as interest rates come up.
Right now, at the end of 2013, it went down to 2.8%.
That's right. That's true.
So here's the rule of thumb. The inverse of a 2.8% rule or a 4% rule would be this. Whatever you're spending, don't give me just your hard expenses. You want to maintain your same lifestyle. If you're going to the country club playing golf, if you're going out to dinner, you still want to do that. You probably do more of it when you retire, right? And so take whatever you're spending. Let's say it's $100,000 a year. The 4% rule will be you multiply whatever you're spending per year times 25. So in that case, $2.5 million, right?
Yep.
If you're going to adhere to the 2.8, the newer rule, the updated rule, multiply approximately by 35. Okay, so at $3.5 million. So no matter who you are, any financial planner, financial advisor, financial whatever that they call themselves nowadays, will tell you need between 2.5 and 3.5 million. So let's say you're 60 years old, you plan on retiring at 65, and you have 500,000. You're not ready. Just remember, those are the numbers you have to use. Now, out of that 100,000 that you spend a year, make sure you take out any pensions, Social Security, and things like that, because you don't need to take those out of your investments. You cannot count real estate or your home unless somehow your home is going to become a cash cow.
Or your real estate's rental properties and it's throwing off some income.
That could come off of your 100,000.
That could come off.
But you want to factor in at least some percentage for vacancies or
taxes,
something like that.
All that stuff.
Right.
Sure, maintenance.
So it's that you're taking this 4% or 2.8% out of your investable liquid assets. Okay, not real estate or something that's not liquid. But take it out of those investable assets, and if you adhere to those rules, remember, whatever you're spending per year times 25 to 35, right?
Right.
Same thing as taking out 4% or 2.8%. If you adhere to those rules, the rules say you should have an 89% chance of not running out of money.
Isn't that crazy? you save all this money your whole life, even the 4% rule, but my gosh, the 2.8% rule. And if you only take out 2.8%, you've got an 85% chance of making it.
89.
Or 89%
That's
chance
right.
of making it. It just doesn't make sense.
Well, that's why I think one of the biggest rise of annuities in the last 15, 20 years. I mean, I got in this business. I'm a stock guy.
Oh, yeah.
We didn't call them financial advisors or anything else. We called them stockbrokers.
We did stocks and we did futures. We
That's
did
right.
commodities, managed programs.
That's everything else was lower class, right?
That's right.
But it's changed because what happened is in the old days, you planned on saving money and living off the CD interest, right? Well, and if you can live on 1%, it still works. Most of us can't.
When I was a kid in the 60s, if you could save $1 million, just the interest off of that, you were set forever.
That's right. Well, things have changed. That's the bit why annuities are so popular now. Remember, we just told you, you got to have $2.5 to $3.5 million if you need $100,000 a year out of your investments. Those rules are pretty hard. You can't have much difference in that. Well, what if $1 million would pay you the same $100,000 and guarantee 100% of the time you could never run out? Well, they can and do, and that's why annuities are so popular nowadays. Because instead of this person that, remember I just made an example, a 60-year-old person that's going to retire in 5 years, they don't have $2.5, $3 million. Well, we can get those income needs covered with $1 million. Well, that is a big difference. And it works percentage-wise, folks, with no matter what numbers. So don't be embarrassed if you got 400,000. Don't be embarrassed if you have 40 million. It all works the same percentage-wise. But annuities will bridge that gap. So don't hesitate to call us if you have any questions, 972-715-2424. Stay with us, folks. We have a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back. And Guy and myself are the kings of something.
Absolutely. It's good to be king.
My wife disagrees.
And as does mine.
But when they're not around, we're the kings of something. I'm just telling you. All right. Right before the break, we had a couple in their 50s. Said they're maxing out their 401ks. It's a majority of their assets. But they're really unsure how and when they could retire. Could you give them a free rule of thumbs? So we went over the 4% withdrawal rule, which has been modified at the end of 2013 to 2.8, and what that means. Easiest way for me with a rule of thumb is to multiply whatever I'm spending annually, subtract out Social Security, whatever it's going to be, or pensions, and then multiply that number by 25 and times 35. And it should be somewhere in between there. So if you need 100,000 out of your savings, you need $2.5 million to $3.5 million. That is the inverse of taking out 4% or 2.8.
And if you need 100,000 out of your savings and you've got Social Security coming and a pension, chances are you and your wife have 150,000 a year income. That's a heck of a nice retirement.
That's right. And so that's a good rule of thumb. Remember how much it's to tell you if you're ready for retirement or how close you are, or how far you are away. Another one is with retirement, like allocating the 401k. Since this couple's assets are mostly in a 401k, how do you allocate them? I get more questions on that than almost anything. You got to allocate. You got to, of course, diversify, right? But you got to start with the first core, and that would be like the rule of 100s. 100 minus your age is the most you should have at risk.
The most you should have at risk.
That's right. Or you can take your age is the part you should have secure, whichever way you want to do it. So let's say you're 65 years old. Most you should have at risk is 35%.
When I see people come in and we help them sometimes with their current 401ks, at least give suggestions as far as allocations because they're not self-directed yet. They can't do in-service withdrawals. And inevitably, they're trying. What I see them do, if their plan offers 7, if it offers 9, if it offers 12 different options, usually mutual funds, you'll see them have 1/7 or 1/12. Right. They'll have a little bit in each pocket because they want to be safe and they want to be doing the right thing. And that's not always the best way to go.
Right. That's true. But you got to start with the core, right? 100 minus your age. Now, the only time that's ever changed, I remember in the 90s, and everybody was using 120 minus your age. 120 minus your age.
That was a stock guy gave him that. Gave him that number.
That was actually a mutual fund company.
Absolutely.
That changed it so you'd buy more stocks. But the truth is, the rule of 100 has been around a long time. Now, that assumes that you're an average, typical person. That assumes Younger person is more risk tolerant. An older person more risk averse. But that doesn't include everybody, because I've seen some 70-year-olds that are real big risk takers, and I've seen some 30-year-olds that won't take any risk. But it is, if you have it as a guideline, it will help you allocate your assets. And remember, that's fixed income to equities. Your equity portion shouldn't be more than 100 minus your age. Okay, I know that's tough, especially a lot of advisors out there that think you should be 100%. But think about it. You're an 85-year-old person. Does it really make sense that you're 80% at risk in the market? Don't get me wrong. You can choose that.
Yes.
But we're talking about rule of thumbs for a general person when they're trying to manage their finances.
And if you'd like to have that conversation with Victor or myself, call in. Sarah will answer the phone and chat with you. We're more than happy to give you some thoughts and some opinions and give you some guidance on that if you're not quite sure what to do. There's no charge or obligation.
Yeah, and that actually was our next question. I'll just kind of go into that one. How do you properly allocate a 401k? Same way, you go with the macro, take, all right, how much should I have in equities? Then you take the amount of equities you have, and how would I weight that? Well, I would weight it more towards U.S. large caps. Does that sound logical?
Yeah, you and I differ a little bit on that. I believe in the Warren Buffett theory, what he told his wife to do when he's gone. Back up the truck, put it all in the S&P, although he told his wife 80% in the S&P 500, Vanguard, and 20% in their bond fund. So I would do the same thing, and usually folks with existing choices in their 401ks, I try to guide them to that. It's 500 companies. They're good companies.
Well, there's nothing wrong with
dividends
S&P.
paying.
You still can't violate the rule of 100, though.
No.
Right.
No. I'm saying of the equity
right.
portion, that's right. I think you diversify from that a little bit.
That's right. I still want some small cap, some mid cap.
And they're doing real well right now.
Value versus growth.
That's
the
right.
S&P does encompass, when you're talking about large U.S. companies, it encompasses the market capitalization of 80% of the U.S. stock market. It does have growth companies in there and value companies in there. So it does a lot, but these are mega huge companies. And so if you look at the returns of small companies in comparison, they've returned a lot more.
They're doing very well right now, too.
So I want to have some of that. Even though they've returned a lot more, that doesn't mean I'm putting the bigger portion of my money in small caps. No, it'd be a smaller portion. So let's say my equity portion, I'm a 50-50 portfolio. So a large portion I will put in the S&P 500 index if you have it available. If not, look for low-cost, large-cap alternatives.
That's right.
Then your next biggest allocation, believe it or not, will probably be international. But I'm talking about international large companies. Not small companies, not a bank in Paraguay, something like that. And then you'll have your mid-sized companies and then your small companies, okay? I'm talking about like Toyota, Mercedes-Benz. Those are large cap. But that's the ideas. If you have any questions about how to allocate a 401k, just general ideas, don't hesitate to call us. It's 972-715-2424. We've been doing this for 30 years apiece.
It's a passion. We enjoy it.
We've never had a customer complain, either one of us, so that's pretty strong when you're doing the stock market, right? Our number again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I want to wish everyone a Merry Christmas tomorrow. Everybody be safe. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice